Hello learners, welcome to our third lesson under capital budgeting. Today we are going to study capital budgeting techniques under certainty. Capital budgeting techniques under certainty. Capital budgeting under certainty. Okay, capital investment decisions under certain conditions. That is our topic today. Our lesson. Remember last time we defined what we mean by certainty. Certainty is where the investors are aware of the dynamics, the market dynamics, like investment opportunities. This is where investors are aware of the prevailing opportunities to invest, where the investors are aware or they know the cost of capital, and they are aware of returns expected from projects. So today we'll be looking at the techniques that can be used in evaluating projects, techniques or methods or tools. We'll be studying the tools or techniques or methods, all right, or methods that can be applied in evaluation of capital projects. And the investment decisions regarding our projects are concerned with the profitability and selection of a project. And remember, in our last lesson we mentioned that investment decisions involve new projects or new investments. They also involve replacement and many other aspects we discussed in our last lesson. So when appraising or evaluating projects in capital budgeting, and in view of the significance of capital budgeting decisions, it is appropriately necessary that the method adopted for appraisal of capital investment proposal is a sound one. It has to be sound. The technique or the tool or the method to be used in appraising any proposal has to be sound. And how do we measure soundness of a technique? Because there are many techniques which you are going to discuss, but whatever technique is adopted has to be a sound one, all right? Because remember, capital budgeting involves investment of a lot of money, so you need to have a sound technique that will enable you make the correct decisions. So, and any appraisal method should provide the following. Okay, how do we measure soundness? I'm saying soundness can be determined on the basis of many factors, which include, number one, a basis of distinguishing between acceptable and non-acceptable project. So the technique to use should be one that enables you to select. There should be a selection criteria. There should be a selection criteria or a decision criteria that you need to base on your decision of either accepting or rejecting a project. So there should be a basis of distinguishing between acceptable and non-acceptable projects. Number two is ranking of projects in order of their desirability. So the technique that is to be adopted should also, the technique that ought to be adopted should be one that can rank projects in order of their desirability, so that if you have several projects, like say project A, project B, project C, project D, the criteria that you use, the technique that you use should be able to rank these projects. There should be ranking of projects. The method should be one that enables ranking of projects, so that project A may be ranked number 3, project B ranked number 1, project C ranked number 2, and the other one number 4, for example. So the criteria should be able to rank projects into the order of desirability. So that is an important factor. Number 3, choosing among several alternatives. The criteria to be chosen should be one that enables the decision maker to choose among alternative projects. Number 4, a criteria which is applicable to any conceivable project. Number 5, recognizing the fact that bigger benefits are preferable to smaller ones, and early benefits are preferable to later ones. So, and again, there are many projects. I mean, there are many techniques. There are many techniques or methods for evaluating and ranking capital investment proposals. In all these methods, the basic method is to compare the investments in the projects regarding the benefits to be derived. In all these methods, the basic method is to compare the investments in the projects regarding the benefits derived. So those are the features or qualities of a good or sound technique. All right, the technique you adopt should bear the features that I've just mentioned. So remember, we are talking about capital budgeting techniques. Capital budgeting techniques. Capital budgeting techniques. And there are two. These techniques can be broadly categorized into two. Number 1, we have the traditional methods or techniques, and modern techniques or methods. These traditional methods can also be referred to as non-discounting methods or techniques. And the modern ones can be also, you can also refer to them as discounting methods or discounting methods or techniques. So there are two broad categories of capital budgeting techniques, two broad categories, and there you have it: modern or traditional. Traditional, also known as non-discounting methods or techniques or tools. Modern, also known as discounting methods or tools. Now, under the non-discounting methods, we will consider we will consider two methods. We look at two methods, and that is number one, the payback period method. Payback period method and the accounting rate of return. Accounting rate of return method. So there are two methods we will discuss under the non-discounting methods, that is the payback period, also known as or abbreviated as PBP, payback period, and the accounting rate of return, abbreviated as ARR, accounting rate of return. So there are two methods that we will discuss. Then under modern methods, we will consider several methods here. Number one being the net. We have the net present value method. The other one is the profitability index method. Then lastly, the internal rate of return. Internal rate of return. So we have the first one, net present value. Number two, profitability index. Number three, internal rate of return. So these are the methods that we'll discuss, and the net present value can be abbreviated as the NPV, profitability index as the PI, and the accounting internal rate of return abbreviation is IRR. So these are the methods that we will discuss in this class. That is number one, payback period. Number two, accounting rate of return. Number three, net present value. Number four, profitability index. Number five, internal rate of return. And the abbreviations are PBP, ARR, NPV, PI, IRR. So these are the techniques that we'll be using. We have they are called capital budgeting techniques or tools or methods. Okay, appraisal. We use them in appraising projects. And before this, I had just said there are certain features that are important that should be considered before deciding which criteria, which technique to employ in evaluation of capital investment projects. So we start with the non-discounting methods. Non-discounting methods. These are the PBP, and the ARR. PBP and the ARR. So we'll start with the payback period, and we are saying these are non-discounting methods. Non-discounting methods. Non-discounting techniques. Non-discounting techniques. Non-discounting techniques. The first one is A, pay back period. Pay back period. And here, just to make it clear, we are talking about non-discounting techniques. Non-discounting. These are techniques where the cash flows are not discounted. Non-discounting. Cash flows are not discounted. What is discounting? Discounting is the process of determining the present value of future cash flows. Future cash flows, you discount, you get the present values. You convert future values into present terms. So the under payback period, for example, or under these techniques, the cash flows are not discounted. So we start by discussing the payback period. Payback period, and the name suggests, you can even guess, payback period. So how do you evaluate projects? This is the question we want now to answer. How do you evaluate projects using the payback period? Using the payback period. How do you evaluate projects using the payback period? This method gauges the viability of a venture by taking the inflows and outflows over time to ascertain how soon a venture can pay back. How soon a venture can pay back. And for this reason, the payback period, or the payout period, or the payoff is that period of time or duration it will take an investment venture to generate sufficient cash flows to pay back the cost of such investment. This is a popular approach among the traditional financial managers because it helps them ascertain the time it will take to recoup in form of cash from operations of the original cost of the venture. All right. This technique helps us determine the number of years, the number of months it will take for a venture or for a project to pay back, to pay off the original investment. If you have invested in a long-term project, now under payback period, we are looking at the time that will elapse before the original amount is recouped. To recoup is simply to pay back the original, the initial capital, the initial investment. So payback period is determined in terms of the years period. We are talking about how many years, how many months will the initial investment be paid or recouped. All right. that is payback period. So this method, I've said, is usually an important preliminary screening stage of the viability of the venture, and it may yield clues to profitability, although in principle it will measure how fast a venture may pay back rather than how much a venture will generate in profits. And yet the main objectives of investment is not to recoup the original cost, but also to earn a profit for the owners or investors, So this method does not help us understand the profitability of a venture, but it helps us know on the outset how long a project can recoup the original investment. So we want to consider an illustration or computation of payback period. And in computation, we'll consider two scenarios. Number one, under uniform annual incremental cash flows, that is uniform annual incremental cash flows, uniform annual incremental cash flows. This is where annual incremental cash flows are uniform, are the same. For example, if you're expecting cash flows for a project of, say, 10,000, every year you expect cash inflows, 10,000 year 3, 10,000 year 4, 10,000 year 5, 10,000. That is what we are referring to as uniform annual incremental cash flows. How do you determine the payback of a project that is going to generate equal incremental cash inflows? So that is a question. So that is one scenario that we are going to learn. We are going to learn how to determine the payback period where the annual incremental cash flows are the same. So if the venture of an asset generates uniform cash inflows, then the payback period will be determined. The payback period will be determined as follows. The payback period in such a case will be equal to the initial capital investment over the annual cash flows. You simply take what you invested, then divide by the annual cash flow. All right? That is how to determine the payback period of a uniform annual incremental cash flows. So, example, a venture costs 37,910,000 shillings and promises return of 10 million shillings per annum indefinitely. Required, determine the payback period for this venture. For in that illustration, the payback period will be equal to the initial investment, and in this case the initial investment is 37,910,000. We divide that by the annual cash flows. From the question we are told that the annual cash flows will be 10 million per annum indefinitely. 10 million per annum indefinitely. So we divide that by this, then without even looking at the calculator, this will be equal to 3.79 years. 3.79 years. It will take 3.79 years to recoup the original or the initial capital investment. The initial capital investment. So that's very simple. You simply divide the initial capital investment by the annual cash flows to arrive at the period. So this means that this is the interpretation. The organization will wait for 3.79 years before the 37,910,000 is recouped or paid back. So the payback period is 3.79 years. So that is one scenario, and that is where the initial annual incremental cash flows is similar or equal or uniform. Then number 2, the second scenario is under non-uniform cash inflows. This is scenario 2. The second scenario, and it's non-uniform cash inflows. Non-uniform cash inflows. Now this is where the inflows are not uniform. For example, in our first question, the cash inflows were uniform at 10 million after the end of every year. The company was expecting to raise 10 million at the end of every year. Under the non-uniform cash flows here, the cash flows are not uniform. The first year may be 10 million, the second year may be 2 million, the third year there may be no cash inflows, and so on and so forth. So under non-uniformity, the payback period computation will be accumulation, or it will be cumulative form, and this means that the net cash inflows are accumulated each year until initial investment is recovered. Example: a project has the following cash flows. We have the table, one column for the year, another column for cash flows, and the cash flows are in thousands. At 0, and that is the initial capital, we can see is 1.9 million. At the end of year 1, 300,000 will be raised. At the end of year 2, 500,000. At the end of year 3, 600,000. At the end of year 4, 800,000. At the end of year 5, 500,000. Required, calculate the payback period for the project. So we need to calculate the payback period for the project, and as I've just mentioned, I hope you have the question papers. I will keep on reminding you, before you attend these lessons, make sure you download the question papers. Me, I have my questions, all my question papers here. So make sure you have copies of these question papers. Class illustration. So this is an illustration, and you want to determine the payback period for the project. And from the question, year 1, as you can read from the question, year 1, we have column for years, then column for cash flows in thousands, in thousands, in thousands, in thousands. So year 1, there is 300,000. Year 2, 500,000. Year 3, at the end of year 3, 600,000. At the end of year 4, 800,000. That is year 4. Then lastly, at the end of year 5, this project will generate cash flows amounting to 500,000. So that is the question. That is the question. So and we are required to determine the payback period. Payback period. And we have seen when you are computing payback period for non-uniform cash inflows, and you can see these cash flows are not uniform. They are different. Year 1 is different from year 5, is different from year 6, different from year 8 and year 5. So here we said you need to do what we call cumulation, cumulative cash flows, cumulative cash flows. So at the end of year 1, we'll have 300,000. At the end of year 2, we cumulate. We'll have the 300,000. The company will have recovered at the end of year 1, 300,000. At the end of year 2, the company will have recovered 500,000. So 300,000 plus 500,000 is equal to 800,000 cumulative. That is at the end of year 2. At the end of year 3, we will have the 800,000 plus 600,000, which is equal to 1.4 million. That is 800 plus 600. And remember, we are supposed to recoup, we are expected to recoup the initial investment in this question is the initial investment from the question again is 1.9 million. You're supposed to recoup 1.9 million. So you see, by the end of year 3, the project has generated 1.4 million. We have not yet recovered the 1.9 because 1.9 is still on the higher side. So we add this at the end of year 4. You can see at the end of year 4, we are talking about 1.4 million plus 800 plus 800, which is equal to 2.2 million. 2.2 million. So as you can see, at the end of year 4, the project has cumulative cash flows inflows of 2.2 million. 2.2 million. So that means that the payback period lies between year 3 and year 4. Between year 3 and year 4. So that by the end of year 4, you see we have excess. So what is the payback period? So in this case, payback period is equal to 3 years plus 3 years plus, because at the end of 3 years, the project has generated 1.4 million. That means that 1.9 minus 1.4 is equal to 500. So by the end of year 3, that is 31st December of year 3, the company will have generated 1.4 million and the balance will be 1.9 million minus 1.4 million, which is 500,000. That is 1.9 million minus, which is the initial capital, minus what will have been raised at the end of year 3. When you deduct, you have a balance of 500,000. This 500,000 is expected to be raised from the cash flows expected in year 4. So out at the end of year 4, you see the project has generated 800,000. So 800,000. So we are going to take a proportion of this 800,000 and so doing we'll need to divide 500,000 by 800,000 so that we take a proportion. This is a proportion because 1 year, in 1 year, in other words, by doing this, in other words, okay, in other words, we are saying here, one year, that is year 4, okay, or you can put it the other way just to help you understand the concept here. To help you understand the concept, we can say 800,000 of year 3, that is 1 year, okay, represents 800 represents 1 year. Therefore 500 will be how many months or how many years? 500,000 will be equal to 500 over 800 times 1. That is the mathematics. This 800 is for the whole year, but you only need a portion of it, a portion of the 500, which will be determined by getting a proportion. Divide 500 by 800. That is what should be done, so that we have 3 plus 500, 3 plus 500, this is 500 divide 800. So this will be equal to 3.6 years. 3.6 years. Okay, 3.6 years. So the payback period will be equal to 3.6 years. That is 3.6 lies between year 3 and 4, between year 3 and 4. So that is how to determine the payback period of non-uniform cash inflows. Non-uniform cash inflows. So the 1.9 cost is recovered between year 3 and year 4. Between year 3 and year 4. So what we have done is simply to learn how to compute. This is how you compute. This is computation. But after computing, then we need to learn how do you use this method to make decision. Because remember, we are talking about capital budgeting decision. We are not just learning how to do mathematics. These are tools. These are techniques which are supposed to be applied. Now, as a finance manager, I need to teach you how you can use the budgeting techniques to make decisions. So we will now move to that segment of what we call the decision criteria, or simply the acceptance rule of payback period. Acceptance rule. Rule of payback period, or simply the decision criteria. What is the decision criteria? What criteria do you follow in making decisions using the payback period? That is the question now we need to answer. We need to consider. How do you use payback period to make decision in capital budgeting? How is this technique applied? What we have done is to learn how to compute. Now, having learned how to compute, then how do you apply the rule, the decision criteria, the acceptance rule of payback period? So using payback period, a company will accept all those ventures whose payback period is less than that set by the management, and will reject all those ventures whose payback period is more than that set by the management. So that is one criteria. Companies have their own policies regarding how the company is managed. A company may have a policy where they have decided that when investing in capital projects, the project that should be undertaken should be the one that meets the period that has been set, the payback period that has been set. For example, a company may have company A. Company A may have a period that is preset or set in advance, say 4 months payback period. For any project that is undertaken, then the payback period should be, say, 4 years. 4 years. 4 years. So if that period is 4 years, then the project that is to be accepted based on this rule should be the one that is less than the 4 years. And we can even use this example here. This example that we calculated. Okay? Company A has set a payback period of 4 years. And it has invested or initiated this project. This project is being evaluated, pending to be initiated. This project, say, is under evaluation. So you are evaluating whether this project should be undertaken or not using payback period. The payback period based on the cash flows you can see is 3.6 years. The company has set a standard of 4 years. So the question now is, should this project be undertaken or not? Because remember, here we are evaluating. This project has not been undertaken. We are carrying out evaluation. And we have data, we have information, we have estimated that these are the cash flows expected from the project. So based on that information and the payback period, then you can see clearly that that project should be undertaken. Why? Because the payback period is 3.6 years, meaning after 3.6 years, the project will have repaid, okay, the initial outlay of 1.9 million will have been recouped or recovered. Okay, will have been recovered after 3.6 years. That means that that period is lower than the one set by the company. That project pays faster. That project will repay itself faster. Okay, so that's how you do it. Company where they have a period, then that's how you determine it. That is one scenario. Okay, then alternatively, payback period may be gauged against the term of the loan, in which case the payback method will give a high ranking to all those ventures which pay before the term of the loan, and the highest ranking will be given to those projects with the shortest payback period. Shortest payback period. Shortest payback period. And to explain that, this is a scenario where the company is financing the projects, it's expected to finance the projects by borrowing. the money to fund this project is through borrowing. And if it's borrowing, then there is a term, okay? There is a term limit to the amount that is borrowed. So where, for instance, a company has borrowed a loan which is expected to be repaid in a period of, say, 5 years. 5 years, that is the term limit when the loan is expected to be repaid. When evaluating projects, and you have, say, project A, project B, and project C, whose payback periods are as follows. Payback period are as follows. Project A, payback period 7 years. Project B's payback period, I'm giving an example, 4 years. And project C, payback period 3 years. Okay? So in this scenario, you have borrowed money you are expecting this money that you borrowed to fund or finance the project. The projects. So you have 3 projects you are evaluating. And you have the payback period for the three projects. Project A, 7 years. Project B, 4 years. Project 3 or C, 3 years. This project's payback period is 7 years, the second project 4 years, the third project 3 years. The loan that you have borrowed is expected to be repaid in 5 years. So which project should be undertaken based on the payback period? That is the question. Which project should be undertaken? What is the criteria that you are going to use? And you just say that where you are using borrowed funds, for example, the loan, okay? The payback period method will give a high ranking to all those ventures paying back before the term of the loan, and the highest ranking will be given to those projects with the shortest payback period. With the shortest payback period. So in this case, the project that you need that should be undertaken should be project C. Project C should be undertaken because it has the lowest payback period. Because on the face value, project 7, you should not even consider it. You should not even consider project 7 because the payback period is way beyond the 5 years. Okay, because this is the benchmark. The only project that should be considered is project 4 and 3. Why? Because the payback period is lower than the term limit, long term. So the criteria here is you select the project with the shortest payback period. By the end of the 3rd year, the project will have repaid the loan. That is the logic. By the end of 3 years, the project C will have cash flows enough to pay back the loan. So that is the criteria here in the event or where loan is used to finance a project. However, in assessing the viability of a venture, it is also important to see which venture brings returns earlier, other things being constant. So those are 2 scenarios I've given under payback period. So with that, we come to the end of our class today. We will stop there for now, and I'll give you an assignment. And the assignment is go and research on the advantages and disadvantages of the payback period. That is your assignment. Make sure you carry out that assignment. Go find out. In fact, you can read from our books. You find we have detailed the advantages and disadvantages of the payback period, which is a non-discounting technique used in capital budgeting. So next time we will discuss the accounting rate of return, which is the second technique in capital budgeting under the traditional methods. Thank you for listening to me. I hope you've learned something today.